I'm just going to talk about three things that are very, very important that you need to be aware of that come up in your income statement or in your statement of changes in net assets. I'm going to talk to you about retained income, I'm going to talk to you about depreciation, and I'm going to talk to you about amortization. Let's start off with retained income. It's very, very simple. If a company has got revenue of, let's say, 10 million MAC dollars, it's got expenditure of, let's say, 4 million MAC dollars, that will mean it has a profit of 6 million MAC dollars. Let's assume they've paid their taxes, everything. On that 6 million, the company will decide as to whether they're going to declare a dividend, pay out some of those profits to the shareholders. And let's say they make a decision to pay 4 million MAC dollars as a dividend. That means there is 2 million MAC dollars worth of profits that the company has made in that particular year, which they are not going to give to the shareholders, but they're going to retain within the company. That is what we call retained income. It's the profits that the company makes after paying all the expenses, but also after taking into account any dividend that is declared and paid out. We call that retained income. So every single year, you'd have to calculate what the retained income is from the income statement. What is depreciation? And you guys have probably heard this term a lot. Depreciation, depreciation. What is it? What does it mean? I'm going to give you a very, very simple example to explain what depreciation is. The accounting standards say this: if you buy any asset you're going to use over more than 1 year, you have to allocate the cost of that asset over the period of time that you use it. And they call it a depreciation expense. So let's do an example. Let's say as a company we go and we buy a motor vehicle for 400,000 MAC dollars, 400,000 MAC dollars. What the accounting standards say is you can't just take that vehicle which you bought for 400,000 MAC dollars and which you're going to use over 4 years and show it as an expense in your income statement in the first year. You can't show 400,000 as an expense in the year that you buy it, because you're going to be using this vehicle over, let's say, 4 years. So with depreciation expense, the accounting standards say you have to show the expense of the vehicle over the period of time that you're going to use it. So our vehicle cost us 400,000. We're going to use it over 4 years. So the depreciation expense is going to be 100,000 MAC dollars per year. In year 1, you show 100,000 as an expense. Similarly in year 2, similarly in year 3, similarly in year 4. So you show the expense of the vehicle over the period of time that you are going to use it. That is fundamentally what our depreciation expense is. Now, the depreciation expense is going to be significant in the income statements of companies that are asset intensive. So if you take a mining company or power generation company or property companies which have got billions and billions worth of assets, they're going to have a very, very big depreciation expense in the income statement. It will be far less for a service-related business. So a consulting firm, for instance, doesn't have much by way of assets, and the depreciation expense in its income statement is going to be a lot smaller. Now, one of the final things accountants throw at you is what we call amortization. What is amortization? It is exactly the same as depreciation. It works in exactly the same way, but it relates to intangible assets. Intangible assets are things you can't touch. So things like a copyright, a patent, any intellectual property, you don't depreciate it, you amortize it. You amortize it. But the principle works in exactly the same way. You would amortize it over what we call the useful life of that particular intangible asset. Probably the most significant intangible asset you interact with on a daily basis is software. And what we do with software is we amortize it. We do not depreciate it, we amortize it.